Banks need money to make loans to people who need money. And we've got to find a way to do this in this current environment. Right? So that's sort of setting the stage for what we need to get done. Let me also set the stage a little bit in terms of what we need to achieve by showing some statistics of where we are today in terms of returns and so on. Now, you heard about the background. I've sort of worded it a little differently. I've said, look, what Basel says is you need to have enough of the right kind of capital. You have to save for a rainy day. You need to make sure taxpayers are off the hook. Market risk, derivative transactions, look, you need to account for that properly. You can't over-engineer your balance sheet. Be careful about that. There needs to be liquidity and maturity matching, and systemic risk, managing too big to fail. These are the concepts. In a very simple manner, these are the concepts behind what we're trying to achieve with Basel III. Right? So it's a combination of capital, liquidity, and system protection. You've heard, as of today, the capital adequacy ratios of the banking system, both public sector and private sector, are actually okay. They're fine. The private sector banks do have a higher capital adequacy than the public sector banks, but everybody is actually fine in terms of the actual numbers. So that's one sort of scenario. We spoke a little bit earlier, and I think the governor mentioned it, Chanda mentioned it after that, in terms of where are we in terms of returns on equity, return on asset. So the ROEs of the banking system, you can say, it's alphabetical order, the lot on the left, public sector banks, you have in general a slightly lower ROE. As you go to the private sector, the ROEs increase. And that's sort of the correlation obviously with the ROAs is also self-evident. You can see what the ROAs are. And that really implies what the pricing is. That's the direction toward the pricing should be. Keep this in mind. Talk about how the growth has happened over the last few years in terms of both assets, equity, what has happened in terms of the loan portfolio, etc., of the banking system. You can see that over the years, the capital has grown by about 17.8%, assets has grown by 17.5%, it's almost matched. And this is an interesting statistic. For purposes of our discussion, and what I've done here is the assets and RWA are considered the same. Standardized model, most of the borrowers are not rated, and therefore it's 100% risk weight. Assume the asset growth is the same as the RWA growth, right? Now, how much equity has been raised in the last 5 years? You heard statistics earlier. If you add what's been infused by the government as well, total amount raised is about $13.6 billion, or 81,600 crores has been raised in the system over the last 5 years. As per RBI, the other statistic here is very important, is the NPA, or the stressed asset figure. That amount is roughly 509,000 crores based on RBI data, or $84 billion. You can sort of see the level of the stressed asset portfolio compared to the amount of capital raised. And on the right, what you see, the graphs really is in terms of how the capital and assets have grown. You see how the capital adequacy ratio has moved on top, and you see how the bottom, you see how the net NPA ratio has gone up. This is the scenario today in terms of what the banks look like, and good reason for this to happen in terms of what's happened in the economy, the government, and so on. And coupled with this, you have the future requirement. What's going to happen? The RBI has phased in the capital requirement over the next few years, and the numbers are here for you to see, but broadly, there's a range that you need to achieve over the next 5 years in terms of capital adequacy. Right. So what does this mean for us in terms of what we need to get done? If you see the capital requirements, we estimate the various estimates over here. Assume an RWA growth of 18%, which is similar to what you've had in the past. Assume an ROA of a percent and a dividend payout ratio of 23%. You will need approximately 347,000 crores by 2019. Right? Now, this is in terms of the actual amount of magnitude. If you take this into account, the amount raised in the public by the banking system is roughly about $5.86 billion a year. And the quantum which you will need to raise is significantly higher. It's more than 10 times. So what you have raised in the last 5 years, you'll need to raise from the markets every year to meet your targets over the next 5 years. That's the implication. We keep saying capital, capital, but that is the actual implication of capital if we are to maintain the rate of growth of lending. And in an economy like ours, as has been said earlier, our economy and the emerging economy will grow through credit. That is an absolute fundamental requirement. There was a comment saying, look, if we do this, we need to increase pricing. So how do you quantify that? How do you figure out how much pricing do you need to increase? And you saw the ROA charts earlier. So what I've tried to do below is really take the ROA of the different levels, and the growth in RWA, right, risk-weighted assets at different levels, 14, 16, 18, all the way to 22. The economy really picks up over the next few years. You could have a higher RWA growth if it's still sluggish, 14, but broadly this is where you look at it. You can see the impact. Let's assume that the ROA average for PSUs 0.8%. At an 18% growth, you'll have to raise 492,000 crores of capital. If that increased by 20 basis points, it's 347,000 crores. The impact is significant. Equally, if you were to price it, let's assume it's the same, the $347,000 at 18% growth at 1.2% ROA goes to 202,000 crores. Implication is that pricing is very, very key. And pricing is not just loan pricing, it's all the the model of banking you do in terms of, look, the fee-based revenue, how much you charge for guarantees, how much do we charge for LCs. Today, as a practitioner, and all of us know this, pricing is below sea level. It has really come off. And there's competition, understandably. There's a huge amount of liquidity in the market. And when Basel III was introduced, there were several articles saying, look, because of Basel III and increased capital requirements, everything happening post-crisis, the European banking system will deleverage. That will have a huge negative impact on the ECB market. And Indian borrowers will find it tough to actually raise this from the Western markets. That was actually the thesis. It is true, except there was a huge amount of quantitative easing which happened. And there was a ton of money chasing yields. That's not going to last forever. The underlying thesis that there is going to be deleveraging, I think remains. The moment you have quantitative easing coming to an end in the US, it started coming to an end. In Europe, well, we don't know when. Japan has introduced it in a big way. So what the European banks gave up some time ago, some of the Japanese banks have come into syndicated loans, and all of us have seen it in syndicated loans that we do. But this is not going to last forever. As we move towards 2018-19, we need to be prepared for this, right? So just bear that in mind in terms of what the implications could be. I'm going to talk a little bit about different aspects over here and then come to what behavioral changes we need to make. So I'm going to set the stage, talk a little bit about some aspects. Look, in terms of RWA, you heard in the standardized model, Basel II, Basel III, not too much of difference. And mortgages largely unaffected, and agricultural, again, margins will remain under pressure, but it's still 100% risk weight. MSME is the same. Mid-large corp, it should say 80% of the corporate book is not rated, it's unrated. In India, it's not rated, which is why under standardized model, if you actually rate, the loans are actually rated, you get a huge benefit, but nobody rates the facilities, right? So for a AAA, for example, if you have a rated AAA instrument, it's a 20% risk weight versus 100 on standardized. So it'll come to later in terms of behavioral changes. Do we need to do something about changing those even under the standardized model? Whether you do standardized or IRB, that's a debate in itself. But even under the standardized model, are we able to take steps which will alleviate the need for so much capital? And in terms of financial institutions, really it's the CVA which is hitting us. There's a separate slide on CVA impact, quantifying what that is, which we'll go through later. Basel III, the advanced model, how will it change? Retail, it'll typically be under 50%, so there is an advantage. And the thesis is that the loans to the retail sector will become more competitive. It's better for banks to shift more to retail than stay in wholesale. So that's given. That's already happened in a number of cases. Agriculture. Now we have directed lending. There was a paper I saw, and I don't know if it's final or it's in process, but there was something saying for this sector, you'll probably have 150% RWA, which means the priority sector stuff we need to do, 18% direct, indirect, agri, will probably have a higher risk weight under advanced. If you choose to move to the advanced model, how do you handle that, right? It becomes more expensive. Infrastructure. Now, in the advanced model, as you know, the internal ratings-based model, you're supposed to use your own financial models, and there needs to be a certain history. It needs to be validated by the regulator. You will typically find in India that the infrastructure sector would necessarily demand higher capital and higher risk weight because the history has been poor. The models will show you that, look, this is a risky place to be in, and you will have RWAs which are significantly higher. How do you fund the significant infrastructure growth that is required in India? That's going to be a huge challenge. What is the right model for it? Yes, we have introduced this IDFs and so on. It's not really taken off. Some beginnings have been made, but the initial project construction risk that you take, who's going to take that risk? MSME, again, you'll have the RWA go up because lower the rating, which is true, smaller the size, lower the rating, higher the capital requirement. So these are some of the considerations. You have the standardized model which we follow right now. There are things we can do there to improve the capital efficiency. There are things which we can do in advanced model which will also potentially positively and negatively affect the efficiency. Our own experience in terms of what we've seen, when we switched to the advanced model, frankly, we saw a fair amount of capital efficiency. A lot of the loans, structured loans, type of security we had, so if you have a loan, you have security. What you do is evaluate the FSV, the forced sale value of certain security. If the FSV is good, you get a significant RWA benefit, and therefore your return on the asset goes up, return on the income goes up. So it's your return, the return on the particular asset goes up. So it has shown to be significantly positive for us, but it can get very punitive if stuff goes wrong in the market, as it has. For stressed assets, the RWA implication under advanced model is very, very punitive. It can go anywhere from 300% to 500%. So you have a 100 rupee loan which is stressed, you need RWA is 500%, right? So therefore, directionally, I believe advanced model is indeed the way to go, but to get there, the next few years, we have to take several steps to clean up our loan portfolio. That is absolutely a given. And if you move to the advanced model and redid some of the calculations, assuming that none of the loans would really go bad, everything is a nice portfolio, it's per historical market, you would find we are much more capital efficient, and that will be covered subsequently, I guess, in the section on RWA management. It's very, very important. Right, let's talk a little bit about the capital impact. I think there's a section on increased capital requirements. Let me not belabor the point. RWA impact I have spoken about in terms of the unrated corporates and counterparties, right? Let's talk about CVA for a moment. There was that Sunil Kaushal asked the question, what are we going to do about CVA? I think Kaku, you asked the question on netting and so on. What's the implication for us? Look right at the bottom in terms of what happens. If you have a 3, 5, 7-year swap, under EU rules on the right, you have 11, 13, 13% of that as RWA, right? In India, based on the current rules, it's 53, 95, and 120. So if you do a typical 5-year loan, it's 95%. Now, guess what? You have a loan which is 100%. Then you have a swap on top of that, it's 93%. On that asset, you have 193% RWA. That is not sustainable. We need to figure out how to address that, and it's linked. And guess what? The RBI says, look, we're going to punish you if you don't have unhedged foreign currency exposure, right? So if you add all that together, we really need to figure out, one, on netting, what we do. Second, it's a different topic on unhedged foreign currency exposure, so let me not bring it up here, but these things contradict each other and make it tougher for us to do business. What steps do we need to take? Right. This is the first one, asset value correlation is more for foreign banks. Let's leave that. The other implication is single borrower and group borrower limits. Today, it is at 15% of capital funds, tier 1 and 2, for single borrower, group borrowers 40%. Basel committee has recommended, it is not a rule yet, recommended that SBLs and GBLs be restricted to 25% of tier 1 capital by Jan 2019. Now, this will have an implication on how much you can lend to the large borrowers. So that portion in terms of your concentration and spread of your client portfolio will also potentially change. Again, this is for RBI, the local regulator, to ultimately implement and decide what the right number for India is. But directionally, this is something we need to watch out for. And finally, I think there was a conversation around leverage ratio. For India, it's 4.5%. I think internationally, Basel has recommended 3%. What this does is really restrict the amount of its total assets. It's assets and contingents, including the market risk element, and that does restrict the amount of potential trade finance and bank guarantees and so on you can do. So you have capital and you have the leverage ratio, both constraining it, right? So, and therefore, you come back to the original point. For us, we need to figure out what the right model is. To get to the right model, what is the behavioral change we need to achieve? And also, guess what? We probably need to figure out what the business model and pricing's got to be to get the right return on our assets and equity. Liquidity impact, clearly we spoke about the LCR, but over here, you've seen level, RBI has come out with very clear rules on this, and clearly one of the requests is on the, as Uday mentioned in the morning, we do need the SLR benefit. Most other nations don't have this, we do. I think as a country, as a regulator, we've always been more prudent, but we need to derive benefit from that somehow. And the one sort of consequence of this, I think, is when you look at the portfolio, you may find more of CP issuances, bond issuances, which banks subscribe to, because they are eligible under level 2 with a 15% haircut as part of the sort of liquid assets under the LCR. So, between working capital loans, overdrafts, etc., you'll probably find a shift a little bit more to CPs and stuff, and banks subscribing to it. The NSFR rules aren't yet out in place, but basically what you'll have is a completely matched balance sheet, assets and liabilities matched. I don't know what the ALM desks will do, but it's going to be tougher for us to have the margin arbitrage between different categories of assets and liabilities. Equally, in today's world, it's going to be very tough for us to get those, the CASA we talk about in terms of nature of the CASA. It's no longer going to be just a CASA ratio. What does that CASA comprise of? Who is that from? For example, if we get current account balances from banks, we don't get any credit for that, right? So, and the banking system is, because of the nature of our business, we keep large balances with each other, right? Nostro accounts, Postro accounts, we have balances, but that doesn't count. So, while it's reported as CASA, does it really count? It will not in future. How do you address that? So, and we report AD ratio today. AD ratio probably is something which may become irrelevant as a reporting tool. It may be more the LCR ratio and figuring out where you are in the NSFR. Look, the other big question is, where is the amount of money going to come from? You saw the quantums which I had mentioned. If you're going to raise every year over the next 5 years, the same amount of equity, more than the amount of equity you raised cumulatively the last 5 years, where is the money going to come from? It's not going to come from the government. Clearly there's a recommendation saying, look, let's ease up on the rules, allow more capital access. It's a political question as much as an economic question. We've got to figure out where this goes. But based on the governor's statement, I'm sure we'll see some direction in terms of what the holdings should be over time. US dollar syndicated loans, I spoke to you about it. Again, hit rock bottom in terms of the pricing. There is an arbitrage right now, but there is a huge amount of liquidity. When liquidity changes, you will find that the people will, you will struggle. The pricing on US dollar loans will go up. Right now, banks are able to access it very, very inexpensively. There's a huge wall of liquidity out there. We've tried to compute. You heard about the capital in terms of, look, you have the equity capital, you have AT1, the additional tier 1. How do you price it? What is the actual cost implication? So we've done a couple of scenarios. First scenario, we've taken a weighted average return on equity of about 10.6% for the public sector banks, a pre-tax ROE of 15.8%. And then we've computed certain standard costs based on current market. And we've said based on the current loans, loan outstandings, what is the sort of cost implication? Now, given the lending spreads, there is a negative carry on the equity issuance and on the AT1 issuance, just because of the additional cost, given the cost of equity versus what yield you get. So you figure out that at scenario 1, where you have a 15.8% pre-tax ROE, the extra burden on loans and advances on the entire portfolio, not incremental, on the entire portfolio is 32 basis points. On scenario 2, where you have higher sort of ROE, it is 80 basis points on the entire portfolio. These are indicative numbers. Clearly, each bank will have a different number, and this is something we have to work through for each bank. But that is how we need to work out pricing and see which direction it has to go. Portfolio management will have much more focus because, look, if you have restrictions on what you can do with your balance sheet in terms of capital, you will necessarily need to be able to churn, sell, securitize, buy protection. And this is something which we don't do here. Ours is typically originate and hold to maturity type market as loans. And we take credit risk on the borrowers, and we take comfort from security that we get. But that needs to change, I think, over time, right? Currently, even the Reserve Bank really doesn't encourage the originate distribute model. But that needs to change. And some small things like, look, this will impact what portfolios you're in, right? This will impact whether you take security, don't take security. And banks which have a larger product portfolio will be better sort of capacitized to do this. Internationally, a lot of people already do this, and this requires coordination between agencies. Insurance, for example, we were allowed insurance earlier. The IRDA came and said, look, you can't take insurance on certain portfolios. So you want to do more for, say, the agri sector or say the priority sector, but there is an insurance product out there which helps you mitigate the risk of these, what one may classify as high risk loans. You should be allowed to take it as a bank, but the regulators between RBI and IRDA, Ministry of Finance, need to work together to make sure those risk mitigants and RWA mitigants are there in place. In terms of conducting business, therefore, in summary, I guess what you have is for RWAs, you have to move to the right assessment of risk. We believe over time it will be the IRB, internal rating based model. To do this, you need to build the data analytics capability because you need to do it for creating the models. Very, very important. And I think the RBI has taken a step in terms of making sure the data they gather from us. It's a huge amount of volumes of data. We know because I think our inspection is just going to start, so we have a huge amount of data we need to feed in. We need to make sure that analytics capability is there. Security creation needs to be speeded up. So simple thing, we have consortiums. What do? We need to create security. If we have a secured loan, there is an FSV on that which gives you a for sale value on that which gives you a certain RWA benefit. But sometimes it takes a year and a half to actually sort of finish creating that security. And meanwhile that lies unsecured and you cannot derive the RWA benefit. If you were to do it faster, there's a mechanism to do it faster, it's more RWA efficient, more capital efficient. You need to be able to securitize parts of the portfolio and that market has to develop. Risk participation, insurance, we do need to make sure that market also becomes active. Portfolio allocation, there are a number of European banks who don't do infrastructure financing anymore, right? And this typically happens as a reaction to crisis and need to conserve capital. We need to be prepared for what portfolios we work off. Do we increase retail portfolio? How much do we increase it by? That seems to be the direction people want to go in. Pricing discipline is an absolute must. Covered before, we've shown you numerically what that will be, and directionally it's very, very clear. NPAs, if we move to the advanced model, and even for just capital conservation, we have to get that in place. And there's a big urgency in making sure we get the, that sorted out very quickly. We think capital markets have to evolve. There's no two ways. I think 2012 there was a research article published showing that the capital markets in Asia have to increase by almost 18-19% per annum over the next several years to take the capacity from banks into the capital market. So that market has to evolve as well, both internationally and domestic. Rating agencies, I think, will become a very vital part of this whole system over here. They are in part today, but then even under the standardized model, if somehow we could figure out a way to use the rating agencies, in a proper manner, we could get significant benefit on RWA. And the other thing is the non-bank financial institutions, the governor spoke about shadow banking and so on, they will play a bigger role because the banks alone cannot finance the growth that is needed in India. We need NBFIs to be efficient, we need an active capital markets, we need products like securitization to take off in a bigger way. So behaviorally, these are some of the changes that one would see happening in this market. Some of the other simple things, AIRB, what is the implication? If you move there, there is depending on the rating, take for example, you're a project company. Go to the first one, project company, it probably is not going to be investment grade. Let's assume it's a BB rated. If you give a 5-year loan, it's 197% risk-weighted assets. Anecdotally, I'm just showing some of these to you so you understand the implication of which path we decide to take. Standardized, it's 100%. A negative pledge on assets. Under advanced model, there is a benefit for negative pledge. It does reduce the RWA, right? So the small things, there's a PD substitution. So if you get credit enhancements, that helps reduce RWA. But security and collateral, there is an issue. Normally in developed countries, sometimes you have a for sale value of 50%, 60%, depending on where you are, what the asset is, and what the models show. We as a bank in India struggle with it because when we go to the regulator or the PRA and say, look, we are secured, they will say, what is your track record in actually realizing the security, right? And we get a very low value for that for sale value because the track record in India of actually realizing security is very poor. How do you set up the mechanism to actually make sure that works? There is a framework, but the actual process takes far too long. Recently, the RBI has announced steps, and I think the direction taken to say, look, it's not a question of selling these, but putting them on the right track is the right one. But you can understand, some of the basic behavioral things that we need to do in the system to make this work better. Look, let me just lay on the table what we need to do to lessen the impact of the capital. One is potentially create an infrastructure for creation of security and enforcement, very important. HQLA, mentioned earlier, permit use of SLR securities, right, with a haircut if necessary. Trade finance flows, permit 100% inflows for all trade finance. FIs and corporates, only 50% are allowed right now. This is the approach taken in Europe under CRD4. Impact of derivatives, netting, huge impact. IRB, look to provide RWA relief in specific sectors by lowering the LGD. So, and then risk management. Let's get risk participation, domestic portfolios, all of that done. these are steps we can take. These are within our control. Forget raising capital. We'll all have to raise capital. But if we do this, the amount we need to raise subsequently gets, sort of reduced. So in conclusion, there is a significant, impact on Basel III. Lending, standardized. Look, if you can get the ratings and so on done, there's a benefit, but it's relatively limited impact. Portfolio alignments would need to target higher margin business clearly. The CVA increases need to be sort of factored in. And if there is a introduction of IRB over time, the impact is going to be higher. There is going to be the new, the regulatory regime will require more awareness of RWA discipline in order to sort of participate in the growth. And ROEs need to be sustained, because only if ROEs are sustained can we go back to the capital markets to raise more money. So that's very fundamental.